The housing market in America is off to a bit of a slow start in 2025. If we were to compare the current home sales right now in around March and April of 2025 to this time last year, you're going to see that it's down about 2%. To further even expand on that some more, they're currently at their lowest level since the Great Recession or the Great Financial Crisis of 2008. 2024 and of course now 2025 have not been great times to sell your home, and you're probably very familiar with the reasons why, and we'll talk about that today. I'm joined by someone that I go to for education in the mortgage world and the loan world. Anytime we talk about the housing market, Brock Irwin is someone that comes to mind for me. He's a good friend of mine, and he's been educating people over at Mortgages with Brock and over at his firm here also in Dallas, Texas for quite a while now. So I'll peg Brock with a lot of questions today that a lot of you are probably asking when we talk about the housing market. What are some of the current trends that you're seeing in the housing market? What are some of the ways that the mortgage rate is impacted? Why is the mortgage rate not the same as the interest rate? What is the difference between a cash out refinance, a home equity line of credit, a home equity loan? What are some potential budgeting and cash flow tips for people on a variable income or those that have a commission? Just overall challenges, of course, faced by home buyers, or even if you're trying to sell your home, some challenges you might face in today's environment. So all that's to come here in my conversation with Brock. I hope you find it insightful. Please feel free to reach out to us at the end if you have any questions, and whoever can help you would be more than happy to do so. Well, thank you guys all so much for joining us today. Today I've got a good friend of mine, Brock Irwin, who is joining us to discuss the fun and exciting market trends going on in the housing market currently in America. As you know, Brock, I'm sure better than me, the housing market has been quite volatile lately. It's been, I'm sure, a normal conversation for you to say, when should I buy, or should I wait and hold out, and things of that nature. So just want to welcome you to our webinar today. Appreciate you taking time to speak. Brock is at Aspire Mortgage over in Plano, Texas, but they have several offices surrounded here in America. But Brock, why don't you just give kind of a quick intro to yourself, your firm, and what you guys do?
Definitely. I appreciate you having me on, Jordan. It's crazy that we got reconnected. Me and Jordan have known each other for like over 10 years now and reconnected down in Dallas. So I'm a mortgage advisor located in Plano, Texas. I've been in Texas for about 8 years now. So really made it home from moving down from Illinois and got into the mortgage business pretty quickly. So got to experience COVID, coming out of COVID, and seeing all the chaos that's happened in the real estate market, especially here in North Dallas. It's been one whirlwind for people if they were looking for a house in 2019, 2020 to see the value of homes today. But I got into the mortgage industry, started growing in my business really locally here in North Dallas. But like Jordan mentioned, we've got branches all over the country, California, all the way to North Carolina. So we're pretty spread out. But love diving into the market, because that's the biggest questions that are happening on those calls. It's not rate. It's really guiding people through what's going to be happening to the largest investment that they typically make.
Mm-hmm. Absolutely. And yeah, we kind of already touched on it right now. If we go back, Brock, to COVID, obviously rates are in a totally different place than they are currently. And when we say rates, I never want to assume that you always hear people just say rates, interest rates. Interest rates are just simply the amount that you're having to pay in order to borrow money from someone, right? So if I have my cousin Jerry and he is very iffy on if he's going to return my bike to me, and he loans that to me, I'm probably going to make him pay me a little bit more to borrow that bike than my other cousin Sally, who's been a wonderful and dear cousin of mine and returns my bike every single time, right? And that's essentially what we're talking about with interest rates. But Brock, walk us through sort of the journey we've been on over the last 3 to 5 years since COVID, and why we're hearing so much about interest rates with housing.
Yeah. So obviously during COVID, it was a great time for people in the mortgage industry. Interest rates were low. We had so many people that were buying homes. Also just moving into the North Dallas area is already exploding. So the interest rates dropping down that low caused what we've seen really happen in home prices over the last 5 years, where they've stagnated a little bit here, just because we saw so much growth during that time period. Because as mortgage interest rates were as low as they were, it allows the purchasing power for so many more people to be able to step into the market, where you can buy a house for maybe cheaper than what was happening with your rent at the time. But coming out of COVID, once the Fed started hiking interest rates, selling off mortgage-backed securities, at that point, it was causing mortgage interest rates to get pretty close to where they've been at for the last three and a half years, where rates have stayed in the 6.5 to 7.5 range. But the main driver that really happened to that was we really had a bad inflationary problem, and we had an overemployment problem. So we have way too much money circulating, and the Fed starting to raise interest rates, trying to slow things down. So we're hitting a few different variables that are affecting interest rates. So it's not just seeing the Fed move the rate up and down, but they're really looking at what's going to be long-term about a mortgage. We're not as concerned about overday lending rates. We're more concerned about, okay, is this bond that we're having here going to be worth it over a 30-year period of time? So if inflation, it started to come down, but now we want to make sure that it's not going to be something that's really short term when the inflation comes down. And if the Fed takes their foot off the gas too early, then maybe the job market being overemployed could get us back in a position where we have inflation run rampant again and cause mortgage rates to stay where they're at or push even higher than where we're looking right now. So it's been relatively steady in that higher 6.5 to 7.5 range over the last 3 years. Now we're just waiting on a few key pieces to be able to break lower again.
Yeah, and that's interesting you say that. One of the things that we always hear from clients is, hey, I see, Federal Chair Reserve Powell go on screen and he just lowered the interest rate. So why can I not go and refinance my home? And we'll get into some of the important questions that we always hear from clients a little bit later. But when we talk about what controls those rates that you just mentioned, so this year, right now, about 6.8% is the current 30-year fixed rate mortgage. What goes into that? Because a lot of people think it's just whatever this guy says on TV. But as you already mentioned, inflation, the global economy, there's a lot more things that pour into this. So tell us a little bit more about what actually decides that rate, essentially.
Yeah. So with mortgage interest rates, it's all going to be, like I was saying, it's more long-term bond related. So if think about the 10-year Treasury more so and the movement of the Treasury, rather than just looking at what the Fed is doing on each meeting that they have that you hear broadcasted in the news. So if we see the Treasury go up to the 10-year go up to maybe let's say 5%, which we're approaching the high fours right now. Typically, there's a spread of about 2% between what a 30-year mortgage interest rate would look like to wherever that 10-year Treasury bond is. Now, what's driving that around? If we see people run to security in the markets, then that's actually going to help out mortgage rates. So it's pulling money out of the stock market, which is actually going to drive inflation lower, drive spending a little bit lower as they run to security, and it lowers mortgage interest rates. Now, if we see booming economies, which as we see earlier this week, as Trump made the announcements on everything with the cost of medications, it gave a lot of people confidence about things that were happening. A lot of money was going into the market. Stock market was up for pretty strongly. And at that point, we see mortgage interest rates take a little bit of a hit this week due to it. So you'll start to notice little factors like that. But as we see big reports about employment, I'm always telling clients to be thinking about what could be more inflationary. And if this is driving growth in the economy, it's probably going to hurt the cost of borrowing at that time and push that up a little bit for a period of time, at least until things steady out. So they know over a long-term period of time that mortgage-backed security is actually still going to have value for them.
Yeah, that's interesting and helpful to know. Well, Brock, I know that you guys have a helpful loan dashboard that you often walk your clients through to help them kind of find the most efficient loan for them. I'd love it if you could walk us through what that looks like and kind of the background of what you guys are looking for when you approach a loan.
This is the dashboard Jordan's talking about. So when we're presenting options to a client, we can talk about interest rate. You can shop around to a ton of different banks and see different interest rates all within 0.25%. No one really runs away from it. So I try to lean the conversation more for putting you in the right financial product, essentially, for how is this debt going to be structured that you're taking on, rather than just, hey, what's the lowest possible interest rate I can find and then call the next guy. So with looking at the way that we present options, and we want to be very involved with how you're conversations with Jordan are going, how your plans for managing your money and your long-term assets are really going to be looking like throughout the year. So we don't want that mortgage to be out of line with that. And it's really easy to get yourself, even though you could have a very good interest rate, get yourself into a bad mortgage that's going to cost you more money over your long-term goals, and it's not going to be in line with what you're really shooting to do. But with this dashboard, it really breaks down all of the different pieces, the comparisons, the break evens that you'll have with different mortgage products that you can take on. Now, one of the main things is that I try to communicate to clients is you can have really any interest rate out there within reasonability, within probably a full percent even. And this is how you'll see a lot of marketing that goes out. So there's higher cost loans that you can take and have a lower interest rate. There's lower cost loans that can have a higher interest rate. But the main thing that we're trying to compare is let's say you spend an extra $5,000 in your closing cost, and you might save $200 in this scenario, $145 between the two options. Then how long is it going to take to be able to break even on that? So what is going to happen in the market within this 36-month period of time you see between these first two options? That if let's say you plan on refinancing or you plan on moving within a 36-month period, taking a 6.99% interest rate is going to be more advantageous to you than taking a 6.625. So there's different ways that you can move things around to be in line with your goals, rather than just saying, hey, they offered me a 6.625, this lender offered me a 6.99. And at the end of the day, they might be the same exact option that align with what you're looking to do. Now, these next two options, this gets a lot into what we were just talking about with the current interest rate market. So banks have opened up so many programs, and they've been around for a long time, but they've been advertised pretty heavily recently. And that's because people want to avoid these higher monthly payments that come along with the higher interest rates. So if we take the same first year option, there's a way to get a seller to subsidize your payment. So as we do these planning sessions before we even go under contract on a home, so it's not find the house, like you get a car, you walk into the dealership, you test drive, you find your car, then you sit down at the finance desk. With a mortgage, it's a different strategy that you want to go about doing it, where you're sitting down with your mortgage advisor weeks, if not months before. Even myself being in the industry, I think I planned out my purchase probably 4 months before I even got going, just so I could get all of this stuff in order. But in this scenario that we've got, there's a way that you can get a seller to subsidize your monthly payment. And essentially for the first 2 years, you're paying a 4.625 interest rate the first year, a 5.625% the second year. Then you go up to that fixed rate. So there's so many different options that you can align your cash flow. You can align your investments, make sure that if you have a large lump sum of money, that it sounds great to have a lower mortgage payment, but it might not be in line with what you're looking to do. So we want to be able to compare really the ins and outs of everywhere that your cash is going. That way it's going to be in line long term, rather than just sound like a cool interest rate to tell your neighbor. It feels like a bragging right almost.
Sure. Yeah, Brock, can you expand a little bit more on that subsidization piece? I don't think a lot of people might be familiar with that part.
Yeah, so a lot of the terminology that you'll hear around this is what's called a temporary buy down. So in this scenario, the first year's payment, so you would essentially ask for the seller, and this is part of the negotiating piece by your real estate agent or with a builder if you come across a new construction home. But the difference in your cost from a 6.625 to a 4.625 interest rate, in this scenario, if it's a $750,000 house, $600,000 loan, that might be a total of 13, 14 grand over 2 years that you'd be saving. So when you're negotiating for that deal, you have that money that's basically set aside into an escrow account that is subsidizing the payment each month down to 4.625 for that first year. So let's show the payment stream here. So this is the buy down subsidy that you'd be receiving. So in your mortgage statement each month, rather than paying that 6.625, right under that number, you'd see a credit of $757 a month for the first 12 months. Then the next month or the next year, you'd get a credit of $387 per month that is getting applied back to your mortgage. Now, with this money, it's allowing you to keep your cash flow where it's at, fit your budget with whatever home price that you're looking at. And a lot of people, if you're in a job that may be commission based and you know that your income's increasing, or you're about to get a big raise, you're about to get a promotion, and this house is going to be more fitting for you, then okay, let's go ahead and use one of these programs. Let's make sure that you can take on that monthly payment if, heaven forbid, something happened and you don't get that increase. But just know, hey, you can get into something slightly with a slightly lower payment at the initial steps. That way you're not forking out a ton of extra money, decorating the house, making the moving expenses, and then you can get in and then get adjusted to that new monthly payment.
Got it. Awesome. Yeah, this is definitely
Yeah.
a helpful tool. And you kind of mentioned something there that I hear a lot of, and it's people that do have that commission, right? It's people that do have a salary. Maybe they're an airline pilot, maybe they're a business owner, either at a large business or a solo business owner, and they have that fluctuation in what they're earning, right? I just spoke with a business owner yesterday that was telling me November and December, they're a real estate owner, they're very light years, or excuse me, light months for them during that time of the year. So they already know that they might not be netting the same amount of income during those months that they possibly can. So let's kind of dive into that question. Let's say you have someone walk in the door. Of course, they're making enough money to purchase a $750,000 house that you just showed, but they're not really sure what their paychecks are going to look like on a monthly basis. So how do you normally approach that?
Yeah, so with getting a pre-approval for a mortgage, that's the easiest thing about getting a home.
Mhm.
It's using what's called your debt to income ratio. So we go over the pre-approval process very, very early, and
Mhm.
regardless of how much you get pre-approved for. So in that same scenario on that dashboard, I think that was about a $5,000 monthly payment. If you
Mhm.
make combined family income of 120 grand, you can qualify for that. It might seem like a lot, but you can qualify for that with the bank. So after
Mhm.
we take that and break that down, then we want to dive over to what are your actual monthly expenses that you're taking on each month. So
Mhm.
what is your full budget that the bank's not concerned about? All the bank's really concerned about is what their risk is with you being able to pay back that loan. But the purpose of really planning it out way in advance is saying, hey, I actually need my payment to be $4,000 for it to make sense for us to take on. So
Mhm.
let's sit down, break down. I've got multiple budgeting scenarios that we'll go through with clients of saying, hey, even if it's how often does your wife get your hair done? How often do you go golfing? Put all of this stuff in here to have a realistic budget. That way, getting the house, which can be a huge financial tool for you, to many, many people end up having a lot of their wealth stored up in their home equity. So it can be a great tool for you, but it can also put you in a very, very bad spot if you
Mhm.
overextend yourself just because you wanted higher ceilings. So
Mhm.
with doing the whole process, you want to make sure you're looking at all of that piece up front. But then if you tell me, and I tell this a lot, it almost sounds like a sales thing when we're going through our call. I'm like, tell me a payment, tell me your cash, and we'll hit it. And it's not
Mhm.
that I'm manipulating numbers, manipulating cost. It's saying there's so many programs out there that you can align your payment. If we're planning it right now, if you're already under contract on your home, then you're kind of behind the eight ball. It might work out where everything lines up for you, but you don't have as much wiggle room to be able to take advantage of everything. But once you start having those conversations early, you might be able to make the same $750,000 house fit a $4,000 payment, a $5,000 payment, a $4,500 payment, and
Mhm.
it'd be the same cash out of pocket for each one. So it
Mhm.
all depends on the way that you make offers. But if you don't plan and know where you want your monthly cash flow, then it's really hard to make those changes once you're already stuck in a legal agreement with a seller to buy their house.
Yeah. Yeah, and that's definitely a helpful exercise, whether you're buying a house or not, just to go through with your wife or your significant other and just look at what your cash flow is. Because we often find that one, folks don't really know what they're spending in a month. And generally speaking, it's going to be much lower than what they're actually spending, right? So that's one of the first and most important things we always point out. The second piece that you had mentioned there, that's always a conversation we have, is moving into an illiquid asset like a house or any piece of real estate,
Mhm.
an investment that you can't turn around tomorrow and sell quite easily without taking a concession or a significant haircut on, is what we
Mhm.
always talk about. So why I personally am a big believer in home ownership. I truly believe it's one of the best parts about living in the greatest country in the world, in America. That is an important piece to remember, is that you never want to have so large of a percentage of your assets locked up in your house that you can't go and go golf and do terrible like I do, or let your wife go and get her hair done.
Man,
Everyone, Brock's a great golfer. He's not going to say it, but he's a great golfer. That's why you mentioned that.
man, that's a great thing to bring up. So when people ask me how much should I put down, where first we want to make sure that the house you're getting is going to make sense. You're not going to hate that you ended up doing that in the first place. But
Mhm.
first go over where you want your budget, where you want that monthly payment, and then minimize how much cash out of pocket that you have to do to get to that payment. Because it is still, even though refinancing isn't like the craziest thing in the world, you have to pay to access your equity. Then when you sell that house, you have to pay fees to be able to sell that to another person to come in and buy it, whether that be commissions or closing costs. So there is a cost to access that money. But if you line up your monthly payment and then minimize your cash out of pocket to get to that payment, you're going to be in a lot better position. I know a lot of people think that it's more risk adverse to do 25, 30% down, 20% down, these large down payments. But if, let's say, every $10,000 only changes your monthly payment by about $70. So for me personally, I feel a lot more comfortable at the end of the month if I have an extra 10 grand compared to $70. That's going to Chipotle a couple times.
Yeah, absolutely. And with inflation, probably one time in the next few years. Let's talk about accessing that those assets locked up in that house for a moment, because that is a conversation we'll have from time to time. If we talk about a credit or a loan from our house, that's probably short for either a HELOC or home equity loan. There's also the cash refi that you had just mentioned there. Would you break down those three for us? Because I know a lot of folks might be most familiar with a HELOC just because that's probably the most common. But go ahead and break down those three and what you guys talk about when a client comes into you with looking to access those funds.
Yeah. So what you mentioned, there's really three separate ways that you can access your equity. So cash out refinance is doing a completely new loan. So you're paying off your current loan and then pulling out your equity and taking out a new loan for that total amount. So if you have a $500,000 loan on your home and it's worth that $750,000, you can pull out that additional $100,000. It's just now your loan is $600,000 and it's based on that current market interest rate. So honestly, a lot of people that have been in their home for a little bit that have enough equity, they probably refinanced in 2021 or 2022 before rates started going up. So you might have a 2-3% interest rate. You don't want to refinance that entire loan into a 6.5-7% interest rate. So the next option that'll really become super popular is the home equity loans and the home equity lines of credit. So it's the easiest way to think about it is essentially a credit card that's tied to your equity. So they're going to be rates that are compounding like a credit card. Interest is compounding like a credit card, but a lot of people will use them to access cash, do projects that they know they'll be able to pay off in a relatively short amount of time. So with it, even though it's a higher interest rate, we want to compare how you're using that cash to the type of loan program that you're going to use, because people still do cash out refinances from low interest rates to high interest rates. If they're paying off consumer debt, maybe they got stuck in a car note that has a 12% interest rate, and they can consolidate that in and drop their overall monthly payment, overall monthly expenses. So there's not one that's necessarily better than the other. The cost of doing them does vary a little bit. So with doing a home equity loan or home equity line of credit, they're very, very low expense, where you might be paying $1,000, $2,000. A full cash out refinance, it can cost you $4,000 to $5,000 to access that money. So there is some variation in that, but similar to the purchase, it's figuring out what you want to or what you need to do and the pros and cons of each one, rather than thinking, hey, it's a stereotype that, hey, they're going through a hard time, they got a second mortgage. The only really time that's bad is if you take a second mortgage and then you use your home equity to go buy a boat. It's probably not the wisest thing to do to finance a boat into your house. But if you're using that money to do upgrades on your home, you're forcing appreciation. You're putting yourself in a better spot. If you're taking that money because you have an opportunity to invest that cash, then it can be a really great thing for you, where let's say you pull out $100,000 and it only costs you $2,000 to do it, you're going to make up that money relatively quickly. So it's all a cash flow thing. When I'm having that conversation, where does this put you at afterwards? If we work with a lot of real estate investors that will try to buy property after property, they're not a single one of them is concerned about the interest rate. They're wondering, how much is this area rent for, and how much cash do I need to use? That way they know how much they'll have for that next place.
Yeah, that's very well put. We often just think of the situation and the client, as you just mentioned. One other way I see it used is if someone retires, of course, prior to retirement age at 59 and a half. Hey, I want to extend my IRA. I don't want to have to withdraw from it right now. another chance to be used, whether we're talking about a credit or that loan. Normally, the only way I differentiate between the credit and the loan, you gave a good example. The credit is similar to the credit card. You simply just get, hey, you get up to X amount that you can spend, and you only have to pay us back for whatever you spend. Whereas the loan, they sort of just show up at your door. Here's your check. You have to pay us back all of it, and that does have an impact with the interest rate applied to it. So that's really the biggest difference that I typically see.
Right. Yeah. And that's where that dashboard we were showing just a minute ago, it's extending out the overall cost for what you're using. So if you pull a home equity line of credit for 100 grand, but you only pull out 15 grand, that might be a much better cost situation for you than having to have that 100 grand hit your bank account and you start paying on it the next month.
Mm-hmm. Fantastic. And Brock, I want to share one of the most common questions that I know you absolutely get all the time. We get it in a similar fashion about the stock market. And that simply, is it better to wait now, or excuse me, better to wait now? Is it better to wait, or is it better to buy now and just plan on refinancing it later? How do you generally answer that question?
Yeah. So it's a tough one because it varies a lot per person, and how long you're going to be in that specific home and what your plans are to do with it afterwards. So if your plan is to bounce around and you like being able to move from city to city or town to town, and you don't like really being in one stable spot, then you'll probably lose money on buying real estate if you plan on selling each one. If you turn them into rental properties, you could still be in a good spot. But if you're the type of person that wants to move around every other year, it's going to take a sec to be able to really take advantage and see that appreciation make you money and be in the positive after all the expenses of purchasing and selling real estate. Now, if it's a thing where you're going to be in that area for a few years, you're going to hold on to it, or like I mentioned, if you're going to be investing and holding on to that property, anytime in the long term, DFW, I think the worst it got in 2008, they lost about 4% one quarter, and the biggest housing crash that any of us have had in our lifetime. So though everybody that bought a house in 2008 is still sitting super, super pretty if they held on to that property. So in the long term, you're always going to come out on top. It's just, if you're planning on this being a short-term investment for you and you're not a real estate investor that is flipping homes, then you might end up losing money unless you just hit the perfect timing in the market, buy in March of 2020 and sell in that summer. So it's very rare to win in the short term in real estate. So it's going to be, do you really like that area? And then how long do you plan on being in the home for it to make sense?
Is that time period you're seeing about 5 to 7 years generally?
Yeah, about 5 to 7 years. Typically 5 years is when it starts being to a point where they're going to recoup their costs. And then also here in DFW, it's a little bit of an anomaly because we have so many companies that are moving into the state. There's
thanks California and New York.
Yeah, there's hundreds of families that move to DFW every single day. So we're a very insulated part of the country when it comes to appreciation. So it's a little bit shorter here. For myself, I've been in my house 2.5 years, and I just broke even per se. If I were to sell it, I'd be able to make my money back, make what I've paid back on my monthly payments. So I'm in a good spot in just 2.5 years. Whereas where I'm from in Illinois, it's probably closer to 7 to 9 years to make that appreciation back up, where it's a little bit of a slower area.
You saying people don't want to move to Southern Illinois, Brock?
Hey man, I love it. Would not take anything back from being from there.
That's right. Yeah, I always share the story of a good couple friend of ours, and my wife and I were looking to buy a home a couple of years ago at the same exact time, and we ended up buying. I think at the time, I want to say mid-6s is what we ended up at. And they decided to wait because they thought that interest rates were going to come down. So they rented an apartment for, I want to say, 13 or 14 months. And I look up today and they recently purchased a home, and their interest rate is higher than ours is. So that's not to say that it's always best to just purchase right now. But what we talk about with the stock market, of course, is you have to be a fool to try to predict the market, right? I think even if President Trump doesn't actually have any say over what Jerome Powell and the Fed are able to do, if we don't know where inflation's actually going to go, if we don't know what relations with China and with all these countries with tariffs, right? There's a laundry list of things that we talk about that could impact the housing prices, interest rates, everything you name it in the housing market. We'd be pretty foolish to think that we know, what's going to happen in the stock market, or what's going to happen in the housing market. So that's something we always try to communicate. I know that that's probably a common question that you guys receive, but it's definitely helpful to think about a few of the things you just mentioned.
Yeah, and the big thing with timing that, where I was mentioned DFW might be a little bit shorter, Southern Illinois might be a little bit longer. It's going to be a different conversation wherever you're at in the country. Look at what that market's doing. Is it a growing market? Is it a dying market? And then that can really help you plan out if it's going to make sense over a certain period. But when it's your time, it's your time. If you can't afford to take on the monthly payment for the house that's going to fit for your family, then it might not be a good time, even if you're in an appreciating market. But if you're in I had a good friend who it probably took me 5 years before when we were talking to end up buying a house. We ended up renting a house together when we were like 20 years old. And he was ready to buy then. He was ready to buy the next year. And he kept sending me, I saved it in our iMessages of this Zillow link, and the value on Zillow just going up and up and up. He ended up getting a great interest rate at the time that he bought. His payment was even higher than what it would have been if he would have bought at the beginning of him actually sending me over that house. So it made him happy to get that lower interest rate. And he's paying less interest, but he's paying less interest on an extra $100,000. So it ends up being the same. And so it's really hard to time it out. Sometimes there's predictors of what's going to happen over the next 8 months, 12 months, but at the end of the day, one report can throw that off, one war can throw that off, and it's just know your numbers, know your cash flow, know what cash you're comfortable with spending, and let that make the decision rather than the market with purchasing a home.
That's well said. Last question I'll ask you, and then I'll let you go, is about those payments, right? So let's say someone comes to you, they're looking to find their right situation. Are you focusing on the monthly payment? Are you focusing on the down payment? Are you focusing on the type of loan? What are you really focusing on when someone is just looking kind of cold blank at a new house?
Yeah, so cold blank, it's going to be the monthly payment first and foremost. And I use it. It kind of throws people off, makes them laugh a little bit. But if I could give you a $10 million house and add a $3,500 payment, you're probably looking at $10 million houses. But let's start with what's going to be important to you. And a lot of people will say, hey, payment's not important. It's just, I'm like, okay, everybody knows that there's one payment that is too much to pay for a house for that specific family. So I said, let's start here and then let's manage the cash. A lot of people, if like I said, we work with a lot of real estate investors. If they're doing like a 1031, that's really the only time that we'll start with the cash that we need to use. But if we start with the payment, move over to the cash, that's going to be super helpful for aligning what might be the proper budget for you. Now, you mentioned programs a little bit, so I want to touch on that. But a lot of that's really based on your credit more than anything. So if you've got relatively decent credit, then you're going to be in what's called a conventional loan. If you don't have perfect credit, let's say you're 680 and below, there's still loan programs that qualify all the way down to 500. So there's so many options for it, but the main one's called an FHA loan, which is the Federal Housing Administration. So there's really a loan for just about anybody, but I wouldn't start with the loan program. As long as you know where you want that payment to be, then we'll be able to figure the rest out. But credit basically tells us, okay, what program are you going to fit into? And then from there, credit, it doesn't really move you around as much as what you'd think. A lot of people were taught, and even myself, I thought you had perfect credit, you qualify for a lot, and some types of financing, it's like that. With a mortgage, it's going to tell us what program you go into, and then it might fluctuate your interest rate by 1/4, 3/8%, but not enough to really change your budget. So we'll start with the payment, then look at your credit, see what program it fits in, and then start planning out from there.
That's helpful. Well, awesome, Brock. Thank you for letting me pepper you with questions today. I know a lot of these are just regurgitated from a lot of our clients. So obviously appreciate your time. Tell people where to find you. I know Mortgages with Brock is really growing on socials. Brock does a great job, as you can tell from this, of being educational and helping people understand how the mortgage world works. So kind of share with us where we can find you and anything else like that.
Yeah, best spot's going to be Mortgages with Brock on Instagram or mortgageswithbrock.com. It'll have all of my information, all of my socials on both of those. Those are kind of the main platforms. I get any sort of educational content out on Instagram because our clients are asking these questions all the time. Your clients are asking these questions all the time. So trying to get those out throughout the day, I'll just take notes and say, hey, what did somebody ask me today? And let's make a video about it, because if somebody asked it, somebody else is wanting to know. But yeah, you can find me, reach out to me on Instagram or just directly through my website, mortgageswithbrock.com.
Awesome. Fantastic, my friend. Well, thank you so much for the time today. We'll get you back on here in the future, but grateful as always for our friendship.
Dude, appreciate you, man.